We're going to calculate stock price for Reynolds Consumer Products. First, we need the market cap, which is $7 billion, and then the stock price, 33.39. So if you take the market cap divided by the stock price, you get the shares outstanding, which is 210 million. Next, we need the free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount that number back to today's dollars. And that is exactly what we're trying to do in this video. Next is net income, which is on the income statement, and that's the profit and loss for a given year. And last is revenue. Now we need to look at the capital structure of this company and figure out the discount rate we need to apply to the future cash flows. So the interest expense is the interest they pay on their debt. That's 241 million. And to figure out how much debt they have, let's go to the balance sheet. In liabilities section, current liabilities, 21 million, current debt. And then non-current debt, long-term debt, 4.2 billion. And interest payments on debt are tax deductible, so let's get their effective tax rate. So the income before tax is 301 million, that's on the income statement. And the income tax is 76 million. So they pay 25% in taxes, so the cost of the debt is 4.25%. And 38% of the capital structure is debt, a little high, but not terrible. Now we need a cost of equity. So we need the beta of this. This company doesn't have a beta for some reason. So I'm just going to have to put 1 in the model because I'm just not sure what it is. So we get a WACC, a weighted average cost of capital, 7.84%. And that's a blend of equity and debt when you combine those together. And that's what we're going to use to discount the future cash flows by. So we estimated the future cash flows in 4 years, and then we did a terminal value, which is all the years beyond year 4. Then we discounted those numbers back to today using the WACC. And the sum of those numbers is the value of the company, $5.8 billion. And when you divide that by 210 million shares, you get a stock price of $28. And it's trading at 33. So it's trading at a 20% premium, so we consider this a sell. So let's look at historical. So it looks like it was trading closer to $28 a few months ago, maybe last year. But the price has gone up. It looks like it's trading at almost its peak currently. Reynolds Consumer Products. So the prices must be getting bid up because there's been a lot of demand for its products during coronavirus. So stocks can always trade higher or lower than intrinsic value. It's really predicated on supply and demand of the market. The more people that want to buy a stock, the higher the price gets bid up. And the more people that want to sell a stock, the lower the price gets pushed down. So everybody has their own opinions on stocks. This is my model, and it's my opinion. So thanks for watching.